All right, let's talk about something big that's on the horizon for the PLAZM protocol. A massive event is coming, known as the Day 78 Cliff. Today, we're going to break down exactly what that means for you, why it looks a whole lot scarier on paper than it actually is, and how the protocol is literally designed to use this event to get stronger. Here's how we're going to do it. We'll start with the countdown and quantify this tidal wave of tokens. Then we'll size up the defenses, reveal the protocol's secret weapon, the bonding curve, chart the likely recovery, and then deliver the final verdict on the system's health. Okay, let's dive right in. There is one single date on the calendar that every PLAZM holder should have circled, highlighted, and underlined. Yep, you're seeing that right. As of today, we are just 20 days away from Day 78. And you need to understand, this is the single biggest, most concentrated token unlock in the entire history of the protocol. And it is coming up fast. So what's the big deal? Why all the focus on this one particular day? Well, it all goes back to the beginning. Day 78 is the exact moment when all the positions created during that initial 7-day launch rush mature at the exact same time. It's like a coordinated unlock for every single one of the earliest backers. Now, let's try to wrap our heads around the sheer scale of this thing. It's one thing to say it's big, but when you see the numbers, you realize just how massive this event really going to be. We are talking about 2,287,648 plasmid tokens, all becoming fully liquid, fully sellable in a single instant on Day 78. And in today's money, at the current price of around $2.12, that translates to a staggering $4.85 million of potential sell pressure hitting the market on one single day. Now, to really put this into perspective, look at this. The Day 78 release is 539 times larger than the entire liquid float available right now. It's also 31 times the current total circulating supply. This isn't a trickle, it isn't a stream, it's a tidal wave. So if you're facing a nearly $5 million tidal wave, what kind of defenses do you have in place? Let's take a look at the protocol's war chest. First, you gotta know that the pressure isn't just on Day 78. I mean, that's the main event, no question. But look at the days around it. There were big unlocks coming on Day 79 and another spike on Day 83. This pressure is going to keep coming day after day, all the way until Day 135, when it finally drops to zero. To fight this, the protocol has its ammo. We've got about $84,500 in active pools. Then there's another $42,000 in unclaimed profits, plus almost $380,000 in harvestable profits. So, if you mobilized every single penny, the total firepower is just over $500,000. Now, that $500,000 best-case scenario gives us about 10.4% coverage against the $4.85 million unlock. If we only count the pools that are active right now, that coverage plummets to a tiny 1.7%. So, on paper, this looks really, really bad. And that brings us to the critical question, right? Is this enough? Can a defense that's only 10% strong possibly hold up? The answer is yes, but not for the reason you think. This is where we have to stop thinking about defense in the traditional way. You see, the protocol was never designed to just sit there and absorb sell pressure with its treasury. It was designed to punish it. And this is where we get into the really cool mechanics of the system. PLAZM trading uses something special called a bonding curve. The only thing you need to know about it is this. The larger your sell order is, the exponentially worse your price gets. It's a feature called slippage, and it is the protocol's first and most brutal line of defense. And let me show you just how brutal it is. Here's a simulation of a worst-case scenario. Someone tries to dump 2.5 million PLAZM. They're probably thinking they're about to cash out millions, but because of the bonding curve, you know how much they actually get out? $16,400. Not millions, $16,000. They completely destroy their own exit. But here's the counterattack. As that dumper is crashing the price, the buy and burn mechanisms are kicking into overdrive. Of those 2.5 million tokens they tried to sell, a staggering 2.49 million of them get permanently burned, wiped from existence. Only about 6,000 tokens survive. That's a survival rate of less than 0.25%. Over 99% of their tokens just gone. And this leads to an incredibly powerful idea. A panic seller's actions don't actually hurt the protocol in the long run. In fact, the the system uses their panic as fuel, turning their tokens into a massive deflationary event that benefits every single person who decides to hold on. So, the protocol weathers the initial shock. What happens next? Let's look at the recovery, because the system is also designed to heal itself and climb right back up. That buy and burn mechanism provides a relentless, steady buying pressure. At a pretty normal 10% daily buy rate, the price is projected to bounce from a low of, say, 90 cents all the way back to $1.80 in about 4.5 days. If the rate is a bit more aggressive, like 15%, that recovery happens in less than 3 days. And underneath all of this volatility, there's a safety net. It's a mathematical price floor, and with all the pools running, it sits at $1.25. But here's the really cool part. This floor isn't static. It's designed to rise by about 0.08% every single day, building a constantly growing foundation for the price. Okay, let's pull all of this together. We've seen the threat, we've seen the seemingly weak defense, and we've seen the hidden strength. So what is the final verdict for PLAZM? It's really a 4-part defense framework. First, punish any large exit with extreme slippage. Second, take that panic and convert it into a permanent supply shock by burning the tokens. Third, systematically rebuild the price with consistent, daily buying. And fourth, always have that rising mathematical floor as the ultimate backstop. When you look at it this way, the outcome is incredibly clear. The game theory is simple. Panic sellers lose, period. They get terrible prices, and their own assets are destroyed in the process. Patient holders win. They ride out the storm and emerge on the other side owning a bigger percentage of a protocol that now has a much, much smaller token supply. So our final verdict is this: the protocol is anti-fragile. Now that's a fancy word, but all it means is that it's a system that actually gets stronger when it's exposed to stress, to shocks, to volatility. This event isn't something to be survived. It's exactly what the system was designed to thrive on. So what's the action plan for you? 3 simple things. 1. Prepare for volatility. It's coming, so expect it. 2. Use these next 20 days to really understand these mechanics we've talked about. And 3, the most important one, when that volatility hits, remember that it's a feature, not a bug. Panic selling is precisely what feeds the protocol and rewards everyone else who has a long-term vision.